Let's start with it. Now you see, if you see this chart, you'll understand the entire mechanism of LC. So here you see numbers are given. Number one is like sale contract between a buyer and a seller. So what happens is, like, usually in an international contract where buyer and seller, they do belong to two different nations or two different areas where they don't know each other. So credibility is a serious concern. Buyer would not like to pay anything upfront. Seller would not like to sell something without getting the payment. So there is a like conflict of interest. Hence, you see, we need to bring in something which facilitates this transaction without any friction. So let's say we start with something called as a credit sale transaction. So seller is willing to give it to buyer, but buyer has to give some surety to seller. So in this case, what is happening is, like, we are going to initiate with the LC, letter of credit. So first transaction in this is like there will be a sale contract. Contract is just a online documentation done, in which it will be mentioned that seller is going to sell these many units of a particular product in discussion at a particular price to a buyer, and a buyer is going to ensure seller that he is going to get the payment. Okay, with this, what will happen is, like, buyer will go to buyer's bank. Okay, the buyer has some banking relationship. It is not like you don't deal with banks and then you simply go into trade, that is cash trade. It is not possible. Most of the time, every businessman will have multiple bank accounts. One may be a lead bank and remaining may be other banks. Now, what they need to do is, like, in case you are a buyer, you have to go to your banker, ask them for a letter of credit. This is what is step number two. Once you request it to your particular banker, what banker will do is, like, banker will send intimation to exporters bank. You see, like, you have your bank as a buyer, you are importer. So importer bank will be there. Similarly, you will be having seller who is also having a bank account. So seller's bank will be quoted in this presentation as exporters bank. So you see, bank to bank relationship is very well established. They are very standard organizations into market. They do have a repute with their name, so they cannot default. Now, point is, like, buyer and seller, they may commit some error, but when it comes to banking system, they, in these institutions, maybe in India or abroad, they don't commit mistakes. Okay, so importers bank will be sending a notification to exporters bank, basis on the which, yani actually they'll issue you a LC, and LC will be given to buyer. Buyer will be sending a copy of LC to seller. Seller will be sharing it to their exporters bank, means to their own bank, so that to validate whether it is correct or not. So after verification, the sale transaction will happen. You see, here you see sending credit is step three, delivering the credit letter to seller. Any seller is getting an intimation, yes, what LC has been issued by a buyer is actually informed to the bank. Now, this is the process through which seller gets confidence to send the goods to the other party. Now, what is there in this LC agreement? LC means, in this, buyer bank is giving a confirmation to seller's bank that in case buyer is not able to make the payment on the due date, which may be after 30 days, 60 days, or 90 days credit period, bank will pay the amount. So there is no risk involved in it. Okay, the moment you get this, you will send the goods to the party. Buyer will, you see, buyer will receive the goods. After receiving the goods, now you see, exporter bank will wait for the total tenure, let's say 30 days time period. So after 30 day, the exporter bank is going to initiate the collection process. Now you see, because it is an automated, nowadays we do have automated processes. So banks, they do use softwares. These softwares are also having their alarms. Alarms means if it is a 30-day waiting period, so maybe somewhere on 27th or 28th day, bank will get a notification, automatic notification. So bank officers from exporters bank will be doing the needful follow-up couple of days before, so that on the day that is 30th, they will be for sure getting the payment either by the buyer or the importers bank. Okay, so once delivery is complete, then you see point number six is like, exporters bank is going to give the documentation to seller. Means just they will have an interaction, and then based on the same, like seller giving it to bank, bank will present it to the importer bank, and once it is done, so you see what importer bank will do, will verify the same, will ensure that everything was done as per the records, and then validation of LC is very important. Again, before sending the goods to the other party, you see, exporters bank, any seller's bank will for sure go for some verification from importers bank, because sometimes these LCs are fake documents. Okay, so you have to just validate whether it is correct or not. So validation is nothing but one bank approaching second bank in a confidential manner with the document issued by the first bank, just to validate whether those documents are genuine or not. Okay, if you see the example of Nirav Modi in India, where PNB Bank was involved, the various letter of undertakings, the similar sort of document, were created. That was created in a very like forged manner. They were not genuine. They don't have any existence in this system. So if you just validate this thing beforehand, you see you can get a very fair idea that whether it is correct or not. If it is correct, then there is no risk involved. Okay. So in total, letter of credit is a bank document that acts as a contractual commitment by a foreign buyer bank to exporter that the bank will transfer the agreed payment amount once the goods are shipped or after the completion of that credit period. Hope this is clear to you. So the entire mechanism is this. Now you see here it is mentioned that it is nothing but letter of credit is an important payment instrument. Without this, you see risk is not getting mitigated. So seller will ensure that some sort of assurance must be there in the form of letter of credit. This is actually a set of documentation to be done by importers bank, and you see it helps exporter bank to have timely collection of proceeds. You see, when letter of credit is actually sent, means when it is being created, banks who are making it, like in this case, importer bank. If it is made by importer bank, so importer bank will charge some fee to their client for making this LC. You see, there is no, actually, this is not a loan. It is actually a commitment, a future commitment. So for this future commitment, what is required as a banker? Let's say I'm a banker and you are a client. So I'll first ensure it that if I'm supposed to give a guarantee on your behalf, you should have your net worth, and I should have some control on it, so that if you default on your maturity date and I'm supposed to make a payment for it, so I do have some sources from where I'll recover it after making a payment to the third party. You see, it is my repute, it is my stature which is at stake if something is defaulted on your side. So when I'm going to make a LC, I'm going to make sure that I am collecting some collateral for it. Collateral means some security, so that in case of a default, not only I'm supposed to make a payment to them, but also I'm supposed to collect the same from my client. Okay, so this is important. Then the charge is important. Charge is nothing. It is a fee. Like let's say it depends for what value are you going to make it. Let's say we charge 100 rupee per lakh. So if it is like 10 lakh rupee, so 1000 is your fee. Likewise, some fee has been defined by every bank. So you have to pay for fee, you have to pay for collateral, and it is actually a commitment for future. So if something goes wrong from our client side, then bank is going to come into action. So letter of credit is same, like it is an undertaking issued by a bank, which is called as issuing bank on behalf of their buyer. Buyer is the person who is importing it to the seller. Seller is the person who is going to export this thing. This is actually a sort of guarantee, is a sort of cover. Yani you are trying to give surety to counterparty that there will not be any default. You see, so here who is the beneficiary? If LC is opened on seller name means the person who is selling the goods. You see, he is the person who is going to be the beneficiary. So on maturity date, who is going to get the payment? It is the beneficiary, the seller. Okay, seller will get this amount through buyer's bank. So buyer's bank has an obligation now here. Okay, these are usually of irrevocable nature. Revocable means we cannot withdraw our commitment. Bank once coming into this type of contract, they cannot run away later. Okay, so we need to be very careful about this. Now, one more thing which is very important on this is like there has to be some uniform standards, uniform customs and practice of documentary credit. This is actually given by International Chamber of Commerce. In short, it is known as UCPDC 600. You see, which came into existence in October 2006. And again, when it comes to practical implementation, it came in July 2007. So since July 2007, across the globe, whatever countries are involved, when I say countries means banks from different countries across the globe. If you have to do some sort of documentation for similar sort of transactions, so you have to follow these standardized norms. Okay, where formats are defined, the terms and conditions are clearly mentioned, and they're uniform across, so that we don't have any conflict when we cross the border. Okay, So next is like what type of requirement is there for letter of credit. You see, sometimes you do have certain complications when it is a trade going on. Physical barrier is a problem. Let's say we do something in Nepal and I'm a party from India, so I may not be able to enforce my rights in Nepal. So the physical barrier is there. Then political system or legal system that we have in place may be a problem. Currencies, different currencies may be another problem to it. Trade and exchange regulations. So country to country, these rules, regulations do change a lot. So if we don't have a standard practice, we don't have a globally accepted instrument. So there may be a challenge in terms of collection and also, hence, letter of credit is very important. Then market and marketing condition. You see, you bring in an instrument which gives you a surety. You see, it always enhances the more opportunity you have in market, and it improves your sales and all. Then you have this is a regular trade practice as a matter of custom. Players are using it. Then financial and commercial conditions. You see, it is a very formal document with all terms and conditions clearly mentioned in respect to various parties involved. So you see, this is the requirement of letter of credit. What are the major advantages to buyer? You see, we don't need any cash payment. This assurance letter, this credit letter of credit is more than sufficient. You don't need cash for any initiating your transaction. Seller is paid only after the shipment of the goods, or let's say delivery of the documents. And one more thing, sometimes credit period, most of the time credit period is also allowed. So after, you can avail this free credit if you have this facility. The other party is having assurance. Once they have the assurance, they'll be happy to give you these goods on credit. And then possibility to obtain more favorable payment terms means once the other party is confirmed that they are going to get the payment, you see, they may be comfortable giving you some relaxations. Okay. And you see, this is like what is the advantages to a buyer. Now advantages to a seller. Now seller means the person who is selling these goods. So obligation of buyer's bank for payment. So you have a clear approach where your banker will be able to recover it from a buyer's bank. So because there is a commitment between these two banks, so you don't have any credit risk in this particular transaction. And if you sometimes require money in advance, you can also rely on your bank discounting your LC. Okay, this discounting of LC may be also a part which may come later, but I'm just telling you, in case of an emergency, you need funds, you can borrow it from your bank because your bank is a party to this contract. So they have seen it that this transaction is happening, and other bank across the border, they are going to give some money to your client. Okay, so you can always do a prepayment and you can charge your interest on the same. Payment is assured in terms, in terms like there is a particular date on which you are going to get a particular amount of money. Things are clearly defined. Uh, and then you see, these documents can be validated from the other party. So bank has to give it in writing regarding the genuineness of the LC. Okay, seller need not bother about the fluctuation of currency valuations if they go up and down, foreign exchange. So it can be a term and condition where you see seller is willing to sell the goods at a particular price at a particular rate of conversion. When rate of conversion is clearly defined, so you don't have any risk. You need not to worry about market changes. Seller need not to bother about import regulations of buyer's country. So you see, everything when you do it through LC, banks will ensure it. Banks will ensure whatever genuine or required documentation needs to be done before the transaction. They'll ensure it that they all are done. Else, you see, bank is not going to issue LC, and the other bank is not willing to discount the same. Okay, so it the onus of all transactions to be completed before the transaction is done means lies with the banker. So banker will make sure that they know cross border transactions, and then they will complete. For a businessman, the botheration has been transferred to a banker. Okay, this helps you. Yeah, sometimes in emergency, you can also go with discounting of receivables. Okay, so this is I told you. So this is your total contract. Once again, we are saying it. So there is one importer, there is one exporter. Exporter is someone who is sending the goods. Importer is someone who is bringing in the goods. So importer has to approach his bank. So in this case, it is SBI, which is shown as importer's bank. So importer bank will inform it to importer that yes, against collateral, they are willing to open this line of credit in the form of LC. So what they will do is like they'll communicate to the other bank. So exporters bank Sometimes what happens is like importer bank and exporter bank don't have any direct connection. So they may bring in a facilitating bank also. Okay, there may be another bank called as advising bank, or there may be another bank called as negotiating bank in between. So in two banks we may have, like let's say State Bank of India is there in India, and let's say there is some bank named as ABC Bank in Tanzania. So maybe they don't have a branch in India, or India don't have any branch in Tanzania. So in that case, we'll be bringing in another bank which has a presence in both the countries so as to have a treat them as a neutral party. Okay. So now these are the various parties to a letter of credit. One is the buyer, second is the seller, third one is the issuing bank. Issuing bank is nothing but the bank which is connected to buyer. So buyer is also called as an opener. Seller is also called as a beneficiary. Advising bank is an intermediary bank. Confirming bank is not nothing, but it is like the bank who is going for validation and cross-checking the genuineness of the document. Then you do have a negotiating bank. Negotiating bank means they are intermediaries. They help you settle your terms and condition, and then they facilitate the entire transaction. Reimbursing bank is the bank who is supposed to make the payment. So seller is connected to reimbursing bank. So these are the various parties: applicant, beneficiary, issuing bank, advising bank, and confirming bank. So we have already seen these names. Let's go forward into letter of credit. Now they are of different natures: revocable, irrevocable. I'll go very short into it. Revocable means where bank has a right to withdraw from the case in case some manipulation do happen. Okay, usually LCs are made, they are irrevocable in nature. Means once you create it for a particular period of time, you cannot withdraw from that contract. Okay, or whatever may be the case. But in revocable, what is the thing is like if some changes happen between the client and buyer and the seller, but without the knowledge of the bank, then in that case, bank has a right to go out of the contract. Okay, so what it means is like whenever you bring in any change between the relationship of an exporter and an importer, so you need to inform, update your banker into the same. Like if they are not updated, then they have a right to go out. Okay. So next is deferred or usance LC. Second is site LC. Now you see in deferred LC, you ensuring payment after a certain period of time. The date of payment is accepted by both buyer and seller. The bank may review the document early, but the payment to the beneficiary is to be made as on the date mentioned. Okay, so this is also called as usance LC, usance letter of credit. Then next is site. Site means you see again it is a letter of credit that demand payment on the submission of the required document. Means once your documentation is done, or once all your procedure in place is done, you have sent for logistics and then invoice is being generated. You see once you have everything in that is required to complete this transaction is there in your custody, you can just provide it to your banker, and banker on receiving all your documents they will be initiating your payment. So now another type is like with or without recourse LC. Now you see here it is being quoted that in case something goes wrong, which is also called as dishonoring. Okay, let's say when the beneficiary holds himself liable to the holder of the bill, if dishonored, it is considered with recourse. Where he does not hold himself liable, the credit is said to be without recourse. Now what is happening here? Now you see in this case I'm telling, ki, let's say uh, let's say there is a buyer and a seller. Buyer is supposed to make a payment to seller, and seller do also have a bank who is seller's bank. This is rarely happen, but let us discuss this context. So in this, what is happening is like let's say buyer is doing a default or buyer's bank, which is not possible. Okay, buyer bank is doing a default on maturity date, due to which, like let's say this bill was already discounted by seller with his bank. Now, seller's bank don't have any way out here. Buyer's bank is not paying, and then seller has also taken the money in advance. Now, and in this situation, you see, this is not a possibility, but still, because we are putting it up, we need to discuss it. So, you see, in this case, what is happening is like if it is a recourse LC, what it means, ki, like if there is a default from the other party, then seller will not be able to get any exemption. So if they have taken the money already from the banker, they have to return it back. So if it is without recourse, then seller, if they have withdrawn the money, they are not supposed to return it back to banker. So it is so simple. But you see, this is a very rare of rarest, because after the implementation of UCPDC, 600, you see standard norms are there in place. So you don't find any LC with this recourse facility. So it has to be in very rare situation. These revocations or revocation means banks are withdrawing from these LC documents will be found. Sometimes your constitution of a bank changes, hence there may be some legal complications. Now, restricted LC is one where specified bank is designated to pay, accept or negotiate payment will be made. Means here we are restricting certain conditions, like bank name is very particular. If instead of this bank, some other bank is going to come forward, so maybe there will be a conflict and hence payment will not be made. So restricted LC means you have to come through a particular channel only. Channel is well defined, and if it is routed through some other channel, it can be returned back. Then we do have red clause, green clause, and standby credits. Now you see, it is very clear that red clause LC refers to a packaging or anticipatory credit as a, but there, you see, this is a contract where there is a clause, especially into it, permitting the correspondent bank in the exporter's country to grant advance to beneficiary at issuing bank's responsibility. Means what is happening is, like, let's say seller wants to have some loan facility beforehand. Any seller is the person who sent the goods, who is expected to get some payments in future, but these future payments are on a future date. So if this seller needs something in advance, so then in that case seller's bank would be in a position to give some credit to them. Now why this bank is willing to give this credit? Because buyer's bank has given, or issuing bank has given their confirmation that yes, they will be making a future payment. So this is coming under red clause. Then there is a green clause. It permits the advance for shortage of goods in a warehouse in addition to pre-shipment advance. Now you see, green clause means what in an LC? When you're doing some, this is like a trade, and in this trade, what you have is like sometimes you have to go for pre-shipment advance. Yani before sending the goods for shipment, there is a possibility that you need to pay some advance. Okay, not only this advance amount for pre-shipment, but also sometimes you see the seller requires some additional finance so as to manage the raw material and other things before they are ready to dispatch the goods. So in this green clause LC, they are trying to put in this thing also. Okay, it is an extension of red clause. Standby credit is similar to a performance bond or a guarantee, but it is issued in the form of LC. The beneficiary can submit his claim by means of a draft accompanied by requisite documentary evidence of performance as stipulated in the credit. Okay, so we'll see to it little bit later. Now, what is the procedure to open an LC? Now, you see, every time whenever a buyer is willing to buy something or an importer is willing to do it, international trade with another party whom they don't know. So, you see, they have to approach their respective banker. Now, when you report to your banker, banker will ask you something. Now, these are some formal official documents. IEC is import export number. Okay, so which is like available with any importer or an exporter. So, which is a government issued uh, serial number. So you see, this is unique and every buyer has it. So it establishes your identity. Then you see whether goods or services come under LC permitted limit or not. Means sometimes there are certain goods which are prohibited in international trade. So you cannot export or import those items. Rare, or let's say some like some valuable items. So you should need to make sure that you are not, as a banker, you are not facilitating your client into such unlawful objects. Okay, then next is like import license of buyer is required. FEMA guidelines for that particular item. FEMA means Foreign Exchange Management Act. This tells you about like how foreign exchange can be like subject matter in your particular case. So if it is foreign exchange, then FEMA will be taken into consideration. If it is within country, so maybe you don't require FEMA because same currency transaction will be done. This is how you need to go into it. And then SWIFT code is like something which is like society or worldwide interbank financial telecommunication. Means what is this is like, if you have to do some transaction in local geographical area, you need to use NEFT and RTGS. For this, you need IFSC code. Similarly, when you have to do it across the border, international border, then you have to use this platform. Now, recently, due to Russia-Ukraine war, Russia has been boycotted by Western world. So you see, Russia has been compelled to take an exit from SWIFT model of doing things. Hence, you see now Russia is looking into alternatives. So they are looking into blockchain and other technologies through which, if they do some transactions, so like they are able to escape from the sanctions put up by Western countries. Now, Russia is the first country who has issued LC based on blockchain technology. Okay, so it is denominated in Chinese currency, and you can check it on net regarding this. So again, you see, it is important if you have a Swift code, it is easy to do transaction. But if it is not Swift, means sometimes you see this is considered to be unstandardized. Huh? You see, most of your banks who are doing international trade, so from one country to another country, you have a very standardized system at place. So if you have Swift, it is very easy to move from one to another. So standard form of documentations are there, like which involves commercial invoices like nothing, but it is bill where they give you the description of the merchandise. They tell you the price at which it is being sold. Okay, freight on board, and then they put the name and address of buyer and seller. So you have bill of exchange, you have transport documents, you have bill of lading, which is given to you at your, like you see the dockyard where goods are being loaded or offloaded. Then you have airway bill. You see when your item of transit is very valuable and it is being transported using airline company, then you have air bill. Similarly, you have postal parcel receipt or courier receipt. So these documents, if they are there, it give a surety that yes, the transit has started. So it is no more with the seller, and it is in the due process, and the bills which have been generated in the due course have been given to the buyer, so that buyer's banks can use it for financing purpose. Now you see you have something called as warranty of title. Warranty of title means it gives a coverage so that later on there cannot be any conflict in terms of the title of the goods. You need insurance document. So you see whenever goods are shipped from one place to another place, there is a high element of risk during transit. So if you have certain insurance like involved in your particular shipment of goods, you see that should also accompany. Then letter of indemnity means indemnification means compensating for a stated loss in a given circumstances. So you see sometimes when you are doing it for a trade, you have to make sure that these letter of indemnities are also supported along with it, because you see you have sent the goods but you have not done insurance, so there is a heavy element of risk. If something goes wrong, who is going to compensate? So that element needs to be clear. Okay, so then we do have Incoterms 2000. Like you see, they have been classified into four groups: E, F, C, D. Okay, so every group denotes a particular thing. So if we go forward, you will find there are, like you see, free carrier, free alongside ships, free on board. You have freight paid, cost and freight. You see different types of conditions are there. Now you see these acronyms will be used in your contract, which is letter of credit. So what it means, you need to have a clarity on the same. So CIF stands for cost, insurance, and freight. Whether it is paid or not, things are need to be very clear. So you see across the documentation, you'll find standardized terms and conditions, which includes these acronyms with standardized meaning to it. So you see, as a financer, you should have a clarity on all these things. Delivered at frontier, delivered X ship, delivered X duty paid. You see, these are delivered duty unpaid, delivered duty paid. You see, these are different dimensions. So this chart will make it very clear. Incoterms are in context to a letter of credit where goods are sold on credit to one party. So here you see seller is sending the goods to buyer, but the entire process of transit is split into so many acronyms. So these acronyms have a specific meaning. Sometimes freight is paid by the seller, sometimes it is supposed to be borne by the buyer. So you see the entire documentation that we are going to do will cover all these things. Not only transportation, but also insurance and the custom amount involved. So everything in the process has to be made clear who is going to pay for it and who is not.